Welcome to the current installment of Tax Stuff You Should Know, which is a podcast sponsored by the law firm of Eric Vox Schiff, LLP. My name is Bob Pluth. I am co-leader of the tax practice group of the firm, and I'm joined today by my partner and esteemed colleague, Gene Magidenko. How you doing, Gene?
I'm doing fantastically well on what is amounting to a pretty rainy and cold day, unseasonably cold for May.
Gene is in our Ann Arbor office, and I'm a resident in Chicago, where it's also gray and cold and rainy. So we look forward to spring. Today's topic is profits interest. Profits interests are a tool sort of in the toolbox of clients who have partnerships or LLCs and want to do some compensation and related planning. It's a common topic that we talk about with clients all the time, and we thought you might find it interesting. So without further ado, we'll jump into it. By definition, a profits interest is an interest in a partnership such that on the hypothetical liquidation of the partnership, immediately after the issuance, the holder of the profits interest would receive nothing of value. So it's a forward-looking interest in future profits and future appreciation. Contrast that with a capital interest, which would be an interest such that the holder would get something upon the immediate liquidation of the partnership. And in this case, of course, when we talk about partnership, we're referring interchangeably with limited liability companies that are treated as partnerships for tax purposes. So here's a quick example. Let's assume NewCo LLC has an enterprise value of $10 million. It has two members, A and B, each of whom contributed $500,000 to NewCo. So NewCo had an initial capital contribution of $1 million. And each of A and B each received 50 Class A member interests. So they're equal partners in that regard. They want, at this point, to issue a 10% profits interest at a point in time when NewCo has an enterprise value of $10 million. So they've done very well for themselves. They want to issue this interest to a key employee who doesn't have the money to make a capital contribution. So a profits interest would be a participation in 10% of the future operating income of NewCo, as well as 10% of the upside in value over and above $10 million. Contrast that with a capital interest where, if they just issued mathematically 11 capital Class A interests to the new employee, which would equal 10% of the total interest then outstanding, those interests would be worth 10% of the company, or $100,000, would result in a taxable event for the recipient as well as a compensation deduction for the company. So we're going to focus on the first of those cases, the profits interest issuance, and not the capital interest.
And so, the treatment of profits interests over time has varied. So for a while, the courts were largely the parties that were in charge of determining how profits interests were taxed, and the case law was a bit all over the place. In some cases, they found that the profits interests were impossible to value, assigning a value of zero. In other cases, the courts, that is, held that the profits interests did have some value. And so in the course of this back and forth, it really became a litigated and controversial issue in a lot of instances. In response to that, the IRS in 1993 issued a Revenue Procedure 93-27, which set forth a safe harbor where the IRS would respect a profits interest as having zero value when it's awarded, as long as it fulfills certain criteria. It's worth mentioning that this revenue procedure is only a safe harbor. So if you're outside of it, you may still have a profits interest, but it is perhaps a little less certain. And that's why when structuring profits interest, almost always, we try to stick within this particular revenue procedure just to make sure that you get the benefit of this safe harbor. And so what this revenue procedure says is that you qualify for the safe harbor if you receive a profits interest in exchange for services to or for the benefit of the partnership in a partner capacity or in anticipation of becoming a partner. The profits interest must not relate to substantially certain and predictable streams of income. So, for instance, from high quality debt securities or high quality net leases, from assets like that. It may not be disposed of within 2 years of receipt, and it can't be a limited partner interest in a publicly traded partnership. Again, as long as you fulfill those criteria, you do fall within the safe harbor, and the IRS will treat the award, the granting of that profits interest, as being a tax-free event, both to the partnership as well as to the partner.
Gene, is there any distinction between profits interests that are vested, that is, the recipient has the absolute right to the interest upon receipt, versus non-vested, such that he or she's got to sort of earn the interest over a period of years?
So that was an open question that was left in the wake of Revenue Procedure 93-27, which the IRS about 8 years later in Revenue Procedure 2001-43 clarified. And in that revenue procedure, the IRS said that there's no taxable event at the issuance of a non-vested profits interest as long as the service provider is treated as a partner as of the date of grant. Again, one of the key points there is that both the partnership as well as the recipient of that partnership interest, the service provider, have to agree to treat that person as a partner of the partnership, which also means allocating partnership items appropriately in accordance with the partnership agreement. And at the same time, the partnership and the other partners are not allowed to claim a deduction, such as for compensation or wages, upon the granting of that interest. Again, reflecting a certain consistency of treatment where there's no tax consequence either to the partnership or to the partner who's being granted the profits interest. And then on top of everything else, you still need to satisfy those criteria in the 1993 revenue procedure too, meaning it has to be held for at least 2 years and so forth.
Interestingly, that later revenue procedure also makes it clear that there's no taxable event to either party, either the partnership or the recipient, upon the vesting of that interest. And one of the clarifications that the service came up with at the same time was that a Code Section 83B election was not required in respect to partnership profits interests. That is, 3B basically gives a recipient of property, profits interests would typically be viewed as property, the right to take into income the value of that property, even though the right to retain the property may be subject to vesting rules. Typically, and it's not uncommon at all, for these interests to be granted such that maybe they vest at the rate of, say, 20% a year over a 5-year period. Even though the revenue procedure does not require an 83B election to be made, we typically strongly encourage folks to make one nonetheless, in the unlikely event, perhaps, that you fall outside of the safe harbor inadvertently. So, for example, as Gene mentioned, one of the requirements of the safe harbor is that the recipient hold on to the profits interest for at least a 2-year period. And you could imagine a situation where there's a grant of an interest, and maybe 18 months down the line, the company is sold, and then the profits interest is either sold or liquidated when the partnership liquidates. And so you'd be outside of the safe harbor. So for that reason, we like to do the AB elections nonetheless. And the consequence there is, because the profits interest by definition has no value, there is no tax due when the recipient makes the make. So Gene, we're going to talk a little bit about sort of the design of profits interest, and think about this in the context of the underlying nature of the business. If the partnership is, let's say, buy raw land and construct an office building with the idea of selling it, there may be very little in the way of operating cash flow. Transaction basically is designed to generate a large capital gain upon sale of the building. So in that case, the key element would be to be able to share in the increase in value of the building owned by the partnership upon its sale. In other circumstances, if you have an operating business, you'd not only want to share in the upside upon sale, but to share in the operating income from the running of the business, which may or may not ever be for sale in the foreseeable future. And profits interest can be constructed in either way. just looking at a liquidity event or looking at both a liquidity event or income from operations as well. It's interesting. In my example earlier, we had an understanding that Nuco was worth $10 million as an enterprise. It obviously puts a lot of pressure on knowing that that estimate is correct. And so having a valuation done before profits interests are issued would be, best practices. Isn't necessarily the case that the profits interests have to be issued right sort of at the money, if you will, such that in our simple example, the new partner would have to necessarily participate in the next dollar of appreciation over and above 10 million. They could be constructed such that they are out of the money. And you could say, well, look, we're counting on you to take the business up to $11 million before you start sharing for your share of the profits interest. That's perfectly okay. What you can't do is construct something that's in the money. So, for example, going back to our example where Nuco is worth $10 million, if we were to say that our new partner starts participating once we achieve $9 million of sale proceeds upon the sale of the business, let's say, that would be a taxable event because it would have value on the date that it was issued. In a situation where a partner, like our example, is coming sort of late to the game when we've already created significant value within the partnership, $9 million in our, again, simple example, there is a way to sort of catch up our new partner C, with a catch-up payment. And the way that we could do that would be to say, well, look, see, if you would have been with us from the beginning, your 10% interest in the company would be worth $1 million, but we can't do that and put you in a non-taxable position. But what we could do is we could say the first $10 million of sale proceeds are attributable to A and B as the traditional owners, but the next $1 million value created could be allocated to C completely. And then from that point forward, anything over $11 million would be shared 90-10, as between A and B on the one hand getting 90% and C getting 10%. So that's a possibility, but again, it puts a lot of pressure on valuation. We often see catch-up payments perhaps being offered or negotiated when a new strategic service provider is coming into the business. Let's say that in our example, B wants to retire and he was sort of the day-to-day guy running the business, and we need to find a new CEO. And that CEO, C, might say, well, you got to sweeten this pot for me just a little bit here, and we'd look at a catch-up payment. As I mentioned earlier, vesting is a common attribute in our design of profits interest. And again, you can use your imagination on that. You can use time-based vesting, performance-based vesting, or some combination of both. The other thing, though, to bear in mind is that almost always these interests would be non-transferable, because what we're trying to do, again, going back to our simple example, is incentivize C to do a good job, to stay the course, to be our partner for the long haul, and to have us create some value. We're not looking for him or her to try to sell the interest or otherwise transfer the interest. So that being considered, Gene, how about some common circumstances where we see the use of these interests?
Yeah, absolutely. So there's a lot of flexibility with structuring profits interests, and really one's imagination can be the limit to a large degree, though obviously you don't want to be too imaginative in the circumstances. But typically where we see this is to incentivize a new hire, a new employee, for instance, a key employee who can't or won't, or it's not viable for them to provide a capital contribution as part of their entry into the partnership. A profits interest can be a very powerful tool in those types of circumstances. Importantly, it doesn't necessarily have to be an employee. So you can issue a profits interest to an independent contractor, and that would fall within the revenue procedure safe harbors. It can also be granted to an entity, so it doesn't have to be to an individual. Although I think in a lot of cases where we do see profits interests, I would say the majority end up being individuals, but it's not necessarily a foregone conclusion. And most importantly, they provide a lot of flexibility as long as you fall within the safe harbor, which isn't that difficult to structure. You can create multiple different classes of interests within a particular partnership, with different vesting schedules and vesting requirements, threshold amounts, and so forth. It's important to contrast this with, let's say, corporations, where, yes, you do have various incentive options for structuring plans to get some of your employees, perhaps options or restricted stock units, various instruments like that. But those tend to be a lot more difficult to structure with a lot more formalities required and more limitations on what you can do, whereas you have a lot more flexibility with the partnership and structuring the profits interests. One thing to watch out for, though, is if you have an entity, let's say an LLC, that may have checked the box to be a corporation and then made an S election, for instance, you definitely do not want to put in profits interests there because the S corporation is limited to only one class of economic rights. So all stock or all units in an S corporation have to have equal economic rights. Creating profits interests in that case would violate that requirement, potentially compromising the S election. Finally, one more quick point is on family run businesses. There are transfer tax, in other words, specifically gift tax considerations where the IRS may reserve the right to value the profits interest outside of these safe harbors. So again, that's something to watch out for. There's a separate set of considerations if you're awarding profits interests within a family run entity to
So
family members.
excuse me, Jude. So you wouldn't have an income tax issue, but you could conceivably have a gift tax issue.
Correct. Yeah.
I
Not in
see.
not It's not necessarily a problem if you have a family-owned company that awards a profits interest to an unrelated third party. But if, let's say, it's a family-run company and you're giving out profits interest to members of the family, let's say parents running the company giving profits interests to their children, that can definitely carry some transfer tax implications that would need to be evaluated separately.
Gene, I'd like to go back for a moment to the corporate alternatives, the use of options or phantom unit plans, phantom share plans, etc. Those are going to create ordinary income for the holder, right?
Absolutely. Yeah.
And
Yeah.
whereas profits interest, the hope would be, at least on the sale of the interest or the sale of the underlying business, would likely or hopefully create significant capital gain opportunities for the holder.
Correct. And I think also it depends on what's going on within the partnership too, because the holder of the profits interest would be potentially entitled to capital gains treatment to the extent that you have items that are taxed at capital gains rates that are being allocated through the partnership. So there would be some benefits there as well.
Okay, so it's interesting. Stay with that notion for a bit. So, in terms of the total impact on the holder, I mean, this is a really good day for the holder of these interests. There's no need to make a capital contribution, so there's no out of pocket investment required. By the way, there's a whole set of special provisions for profits interests for professionals, if you will, that deal in the business of raising capital and generating profits for others, like hedge fund folks, for example. And that's Code Section 1061. That's really beyond the scope of what we're talking about today. But among the special rules there is the interest has got to be held for 3 years typically before it's sold in order to meet those requirements. But going back to our sort of general profits interest, as mentioned before, there's no tax on either the receipt of the interest or the vesting of the interest. There is this capital gain potential, as we mentioned, upon the sale of the business. In the case of a profits interest that also shares in operating income, of course, if the partnership is, a manufacturer and its operating income is ordinary income through the sale of its inventory, let's say, just as an example, that would be ordinary income to the profits interest holder to the extent that he or she is sharing in that source of income as well. There is, as a downside, the potential for phantom income or dry income, as we refer to it from time to time. So a profits interest holder is a partner, is a real partner. He or she starts to get a K1 with their allocable share of tax attributes, as Gene mentioned earlier. So let's say if the partnership makes $1 million in profits and C's got a 10% interest in those profits, C would get a K1 with $100,000 of income on it. So C wants to be very focused on the fact that the company will also make a tax distribution to him, let's say, to enable him to pay his taxes on holding the profits interest. If that isn't the case, C might find himself, in a real bind come tax reporting time by having to pay, $40,000 in income tax by virtue of holding the interest, but getting no distributions. Tax distributions are very common and typically not an issue, but it's something that you'd want to look out for if you're the profits interest holder. Likewise, C in our example here, our profits interest holder, is no longer a W 2 employee. In the eyes of the IRS, you're either a partner or you're an employee. And once you become a partner, no more W 2s. Now, we do bump into situations from time to time where companies and tax preparers continue to issue both W 2s and K 1s to profits interest holders. That's something that the IRS doesn't agree with and frowns upon. So, what that does, if you sort of follow those rules properly in the eyes of the service, it puts the holder on an estimated tax payment regime like any other partner because the holder isn't having by the partnership any longer. And so one of the things that really that underscores is the fact that in coming up with a plan to issue profits interest, they're not for everybody. This wouldn't be something that you would do as an employee benefit across the board for all of your rank and file employees. It would typically be for more highly compensated folks, folks that are perhaps more able to deal with a slightly more complicated personal tax return because now they're getting a K1 rather than just a W2, and also folks that might be able to more easily deal with multi-state filing. If Newco, in our simple example, is a manufacturing company and it's got operations in 2 or 3 different states, the holder of the profits interest is going to find himself having to file state income tax returns in multiple states. And so that might be viewed as more of a burden than a benefit, depending upon the nature of the services being rendered and the sophistication of the individual that is the recipient of the profits interest.
And I think that's a very good point, Bob, because the profits interest holder would be a real partner for not just tax purposes, but also for corporate state law purposes, which means that there would be fiduciary duties owed by the partner to the partnership and vice versa by the other partners to that partner. There may be duties to share books and records, for instance, on the part of the partnership with the partner, which again reinforces the idea that this isn't something that you would necessarily want to create for every employee, but perhaps just for key employees where there really is an important nexus and where the complexity of this type of arrangement might make more sense, where it wouldn't necessarily be the case for kind of more rank and file types of workers at the partnership. With respect to the impact on the partnership and on the other partners, just a very quick note there, keeping in line with the idea that the granting of a profits interest doesn't carry income tax consequences, you would not have a compensation deduction on the issuance or the vesting of a profits interest that would be allocated out to the other partners. So it would really be a zero event for the partnership, as it would be for the profits interest recipient. In practice, though, once that profits interest is issued, once profits begin to be allocated to the holder of that profits interest, you would effectively be able to deflect income from the partnership to that profits interest holder, which would reduce the amount of income that would be borne by the other partners. In that respect, it economically at least is kind of similar to a 100% deduction that the other partners would be able to get with respect to that income. So, that may carry some benefits, of course, to the other partners, But also, it would mean that there would be income recognized by the holder of that profits interest. In that respect, perhaps it's not that different from hiring somebody, where you take a deduction for the compensation paid to the employee. And so, in this respect, too, there would be, economically at least, a similar outcome, but with a lot more complexity, perhaps, to the arrangement than you would expect with just a more plain vanilla employment agreement.
Understood. Understood. And there's an opportunity, obviously, to deflect capital gains likewise to the profits interest holder upon the sale of the underlying business.
Exactly.
Well, one thing I wanted to go back and just reiterate is in a case where the profits interest allows the recipient to participate both in operating profits and in capital event proceeds, if you will, sale of the business, refinancing of the underlying debt of the business so that you can make a large distribution out, say, of debt proceeds, things of that nature. The participant can start participating in operating profits immediately upon the receipt of the interest. Going back to our example, the $10 million threshold amount doesn't have to relate to any cash of any sort that comes out of the business. It must relate to sale proceeds if the business were to sell its assets and liquidate. It can, as a business matter, relate to all cash proceeds from wherever source, but doesn't have to. So, for example, as I mentioned earlier, if Newco starts making profits the year right after the issuance of the profits interest to C can start participating in those profits right away, even though C will only participate in the sale proceeds upon the sale of the business over and above $10 million made. And that's the reason for one of the requirements in the safe harbor that there can't be a predictable cash flow from the business. Because the idea is that even with a well established business, there's often not a guarantee that there'll be profits at all, much less to know exactly what those profits might be. And the service, going back to the 1993 revenue procedure, is resigned itself to tax the profits interest holder on his share of operating profits if, as, and when they are actually incurred and placed on his K1 and then subject to taxation in the normal course. With that, Gene, any further or final comment?
No, I think that, that was a very good primer, if you will, on profits interest. There's a lot more nuance there. So I think we only hit on kind of the basic points just as a caution to anyone listening that this doesn't purport to encapsulate the entirety of learning on profits interest, just the obligatory disclaimer, if you will.
There you go. Spoken like a true lawyer. Appreciate that, Jim. Well, look, we look forward to any feedback that you might have. Let us know if you find these podcasts helpful. By all means, let us know if there are any particular topics that you'd like us to address in the future. And you can reach out to us at taxstuff, TAXSTUFF, all lowercase, at afslaw.com. So until next time, Gene, we'll see you soon.
Take care.
You too.